Hi, Mike.
All right. Hey, everybody. Let's go ahead and get things started here. Thank you all for tuning in. I think we'll have a few more people filtering in as we get started, but we're just going to go through a couple of introductions so we're all on the same page. Thanks for coming out to funding your dream home. You hear a lot about finding your dream home, but today we're going to talk about how the heck you fund that. So should be some pretty exciting stuff. We get a lot of questions on this one. Today I am, let's do a couple introductions before we get into it. So my name is Mike McElroy. I'm the founder of Center Coast Realty. A little bit more about Center Coast in just a second. I'm joined today by the incomparable Aimee Renkes, VP of Mortgage Lending at Proper Rate. Aimee has helped a ton of our clients, a ton of our buyers get financing for their mortgages, for their dream homes, and we love working with her. I myself, I'm not just a partner, I'm also a client. Working on my refinance right now. And I have to say the process has been really smooth. Awesome. I've gotten a few mortgages. It's a lot of paper chasing, but the platform that Proper Rate has put together makes things a lot simpler. Awesome. So that's been great. Thanks for being here, Aimee.
Thanks for having me.
All right. Before we get into the content, a quick little bit about Center Coast. We are a real estate brokerage. We help Chicagoans buy and sell homes. We're a little different than some others. When you actually work with most of the bigger brokerages, you're actually working with a 1099 independent contractor. So it's a little different setup. They might just be doing real estate as kind of a part-time gig. They might be great, or they might be a little more part-time. We've heard from some clients who've worked with others in the past that sometimes they feel like they're kind of just trying to get a commission and just push the first house that they walk into. So we're a little bit different around here. Our agents do get a commission, but it's based on client satisfaction, not on how expensive of a home they buy. We also have project managers who are dedicated, kind of check all the boxes, make sure everything's running smoothly. And we work as a team to kind of make the whole thing run together. So this is our team right here. All in, you get a little bit more modern, a little bit more relaxed buying experience. So enough about us. Oh, I flew through a few things there. Getting clicky over here. Let's talk about why we do this. So you may know, a lot of people know that real estate is an incredibly powerful way to build wealth and also just build opportunity for yourself. So educating people about how to do that is a really big part about our business, but also just about our mission. We want to make real estate accessible, not opaque and not intimidating. And after working with hundreds and hundreds of home buyers over the years, we've gotten the most questions about mortgages. So we're going to do a bunch of these webinars over the coming months. We're going to start right here with mortgages and tackle this one first. Especially right now, because you might have heard a few things. Mortgage interest rates are as low as they have been in literally ever. And I mean literally, not figuratively, the way it's often used.
That's right.
If you look at a graph, the lowest, yeah. Literally the lowest. If you look at a graph of all time, you can see back in the 80s when they were like 13, 14%. And then 10, 15 years ago, everyone thought like, oh, a 6% rate, that's amazing. It's as good as it gets. Aimee, what are rates at right now?
I mean, for a good old condo purchase, you're probably looking right around 3%. Some days it's just a little bit underneath that. It depends, of course, on how much you're putting down in your credit score. For other loan terms, we're as low as 2.5%, which is just honestly stupid low for what it's doing.
That's bananas.
It is bananas. I say that a lot, actually. I think I personally am doing a refinance right now, as are you. I would say now is a really good time. If people in the know and in the business are doing it, this is the time to look at trying to lock in sooner than later.
The rate I got from your company actually 4 years ago now, I thought I would never refinance. I thought I can never move. This rate's too good.
Oh, I've said that so many times. I'm never moving. My rate's so good. Luckily, I'm still really happy in my house, and we'll be happy to have an even lower rate than I ever thought possible.
Yeah. So how do you take advantage of this, right? Sometimes the mortgage process can be a little bit opaque. And the big one, it's intimidating kind of taken as a whole. So we're going to walk through it step by step today. And the big one here, there's a ton of information you can get out there on the internet, blogs and blogs and blogs. And we write a lot of blogs. But the truth is it kind of varies. It varies a little bit based on your particular situation. It also varies market to market. So we're going to talk about Chicago and the Chicagoland area today and what the mortgage market is like around here to give you some more relevant local advice. So enough about us. Let's talk about you. We got a couple of polls here. I just want to kind of get a feel for the room right now. So before we get started, I want to know, where are you in the home buying process right now? Are you just kind of curious about what's going on? Are you starting to see some homes online, maybe in person? Have you gotten pre-approved yet? Maybe you're under contract and you're trying to kind of figure out what's next. Let's see where we come in. Okay, so a lot of people at the beginning phase of the process, and that makes sense. You are in the right place. If you're just kind of curious what's out there, looking at homes on the line, even if you're already pre-approved, we're going to talk a lot about what comes after that. So you'll be well prepared for the rest of the process, even after you're pre-approved. So good stuff. We also want to know if you've ever bought a home before, real quick. Anyone here ever buy a home? Assuming most people, this is probably their first rodeo, but hey, even if you haven't, mortgages change. It's good to refresh yourself. So that's great. And I know we have a couple people, I think, calling in, so they probably won't be able to vote. Last thing, curious to know where you're looking to purchase a home, because that can impact things a little bit too. We have a number of Chicago neighborhoods on here, but obviously feel free to fill in that other box if this doesn't apply to you. We just want to make it quick and easy if you happen to be buying in any of these neighborhoods. And once you've voted there, go ahead and pull up the chat box. I'd love to hear if there's anything in particular that you're hoping to learn today. What kind of drew you to this phone call? We're going to cover a lot of content, but I want to make sure this is relevant to the people in the group. So once you're done voting there, let us know kind of what are some of the things that, that you'd like to hear from us today. We can make sure to address that. All right, while you're formulating those questions, I'm going to move on, but feel free to chat in basically anytime. And whichever one of us isn't talking, we'll be able to answer some questions off to the side. So here's our plan for today and what we're going to get into. We're going to start at the beginning. How do you get started with getting a mortgage? What do you need to prepare yourself for this whole home buying journey? A lot of people want to know, how much money do I need for, buying a home, buying a condo, buying a single family home? How much cash do I need up front? How much is going to cost me on an ongoing basis? We're going to break all of that down for you. We're going to tell you how to get pre-approved, the steps you need to take. And then finally, we're going to let you put it all into action. How do you, all right, you've gotten yourself prepared, you've gotten yourself educated. How do you go out there and get started with things? So that's our agenda for today. Let's take it from the top. We're going to start about, we're going to talk about how to get started first. So I'll kick things off here and I'm going to pass it over to Aimee pretty quick. I want to stay in my lane. Aimee knows all about mortgages, but I do want to talk about this because a lot of times the first person that someone talks to about buying a home is a realtor, and that makes a lot of sense. We help you do that. We recommend that you start the process at least 3 to 6 months before you're ready to get started looking for a place. And by start the process, I mean, reach out to a lender and have an initial conversation. You don't necessarily need to get all the way pre-approved. That's a conversation you can have with someone like Aimee. But here's why. And a lot of people, we give this advice a lot, and a lot of people say, oh, I'm not looking to buy for a couple of months, or I'm not looking to buy for 6 months. And I think they're worried that like if they get talked to a lender, they have to buy a home, and that's not true. We're kind of just here to be a resource, both our team and Aimee. We want to get people prepared so when you are ready, you're in way better shape. No one's trying to talk anyone into spending $500,000 around here. We just want you to be prepared. And things that come up are your credit score. So you might think, hey, I got great credit. Credit score is like 738, top 10% in the United States. And that's awesome. But if you boost your credit score by 3 points, you might actually save 1/8 of a point on your interest rate, which could save you thousands of dollars over the life of your mortgage, or boost your buying power just a little bit to get that place that you really want. So if you know that now, Aimee can give you some tips for how to boost that credit score up. So when it comes time to buy, you're in a better spot. You might learn that you need to save a little bit more money to hit your down payment goal, or you might learn that, a lot of people think I've got to put down 20%. And that kind of comes from, the generation of people who bought homes. I know in my case, it was my parents. When they bought a place, they had to put 20% down because interest rates were 11%. You didn't want to be paying interest on all of that. But with rates at 3%, sometimes financially, it actually makes sense, even if you have the money, to invest that money elsewhere and then maybe do like a 10% down mortgage. So you might find out that you could buy a little bit sooner than you thought you could. So all really good reasons to reach out and just have an initial kind of Q&A with a lender, at least 6 months out. And when you start researching mortgages, you're going to hear a lot of terms thrown around. These are two of the biggest ones. So I'm going to kick it over to Aimee to kind of break down the difference between a pre-qualification and a pre-approval.
Awesome. Thanks, Mike. Yeah, I think it's definitely terminology that you will see a lot, and quite often interchangeably, pre-qual, pre-approval. So what's really the difference? The general difference truly is a pre-qual is based simply on what you have told a lender about your financial situation. So you could say, I think I have a 740 credit score. I make $100,000 a year. And they'll say, okay, well, how much do you have in monthly debt? Student loans, car loans, credit cards. You might say, okay, that's $1,000 a month. And then we would do a calculation on what you would be pre-qualified for based on what you have verbally told us. So it's a good start. And for people that are maybe not going to be buying for months down the road, that may be sufficient. I would argue, though, that a pre-approval is a stronger and more thorough way to determine what you truly qualify for, because with a pre-approval, we're getting enough information from you. We're getting your authorization to run a credit report. We want to see what's on a lender's credit report, especially for that credit score, because I know probably most of you are doing some kind of credit monitoring. Most of our credit cards are offering that now, Credit Karma, et cetera. All of that's out there. But one of the challenges with credit scoring is those are all consumer models as far as the algorithms that are used to generate the credit score. It's not exactly what a lender or other creditor, if you were applying for a car loan, for example. We are looking at a little bit tougher criteria in that credit scoring system. So you might think you have a 740, but when we pull your credit, maybe it's only 715. And that's not a huge difference, but as far as the interest rate you'd qualify for and the terms of your loan, that could easily be 1/8 of a point to a 1/4 point difference in your interest rate. And if you're paying PMI, make that more expensive. So if you give us the opportunity to do that credit check early on, meaning before you found a place that you're in love with and want to make an offer on, there might be an opportunity to do some things with your credit to improve the situation. It might be paying off a credit card or paying down a credit card or increasing the loan limit or the credit limit. There are many things that we can do. So if you go through that full pre-approval process, it gives you a lot more opportunity there to determine on the credit front where things are and how you could handle it. Additionally, you're going to feel more confident, like this is pretty legit, right? We have an automated underwriting system that we would process your application through to make sure not only Aimee Renkes thinks that you should be able to get a loan, but the automated system agrees. So you can shop with greater confidence with your agent. So that's really my, call it more than 2 cents, I guess, my dollar's worth of advice on the difference between pre-qual and pre-approval. I do know, people are often concerned about having their credit pulled too far in advance and will multiple inquiries hurt my score? And the answer is there's no simple answer to that because everyone's credit score is unique to them, like your fingerprint is. So I can't tell you with certainty if I pull your credit, it will drop 4 points. It may only be 2 points. It might be 20. It's hard to say based on your profile. But I do think if you are serious about moving forward, it's an important step to take. And my last point on that would be with the credit check and the pre-approval. Sometimes if you're monitoring, say, with just one of the 3 credit bureaus that are out there, you might not know that one of the other credit bureaus has a collection that's been filed in your name. This happens a lot. It could be as small as a copay on a medical payment. It could be, never returned the cable box to Comcast. There could be a parking ticket in various towns that will turn you in for collection. If you're not looking at all 3 credit bureaus, it's very easy to miss some of those things. So that's another little tip for why doing that full pre-approval and credit check is really valuable. So what loans are available, right? So, okay, you don't have enough cash to buy most properties in Chicago, and very few people do, so that's okay. There are different loan types. So conventional, FHA, VA, and jumbo. Like, what does that mean, right? Okay, conventional simply means if you have ever seen in the news the name Fannie Mae or Freddie Mac, which are basically the government entities that set all the rules that lenders follow to loan money up to a certain loan amount, that is what we would call a conventional loan. The loan limit for that is $510,400 in the greater Chicagoland area. So that has increased almost $100,000 in the past 5 years, which is fantastic from a accessibility to good financing options standpoint. That's most likely what most buyers are going to use for financing in the Chicago market. Another option would be FHA or VA. So with these 2 loan programs, they're really great. The federal government is providing the mortgage insurance and the backing behind those 2 programs. So FHA could be for anyone. It doesn't have to be a first-time home buyer. And often it only requires 3.5% down. Often we're seeing that for people that maybe have had some credit challenges in the past. Maybe you had a bankruptcy or you don't have much established credit yet and your score isn't very high. That might be a great alternative for you. The loan limit on that is significantly lower than conventional, so it's not always the best option. And in Chicago with condos, FHA can be a little bit more challenging. So that's something with your lender you'd want to talk through what some of those different options are and determine if that would be the best choice or if a conventional loan would be the best choice for you. In VA, that's purely if you are a veteran or on active duty. That's a great benefit that the US government offers to our veterans. And it's actually a no money down, a 0% financing loan option. I love doing those. It's super fun and a great way to give back to people that have done much for us as Americans. So that's that kind of loan type category. And then that jumbo loan, you remember I mentioned conventional has a limit on how much the loan can be of $510,400. So any loan amount that's above that threshold would be considered a jumbo loan. Now, if you remember nothing else, then there's some kind of loan limit. It's not about the purchase price per se, it's the loan amount over 510. The other takeaway is you're not going to do no money down or 5% down on a loan that would be over 510,000. That financing is just really not available in the market. So there's just less options and more down payment requirements typically for jumbo. As far as loan rates, so we've got fixed rates and we have adjustable rates, and they're pretty much exactly what it sounds like. Fixed rate would simply mean that interest rate will never change and the principal and interest that you pay on the loan is never changing on you. So that's what a lot of people feel really comfortable with. Adjustable is exactly that. It means that at some point, at some fixed point in time, your interest rate will adjust either up or down, and then your monthly payment would increase or decrease relative to that adjustment. So for some people, if you're like, I am really not going to live in this condo for 5 years, I know I will not be here longer than 5 years, then maybe looking at an adjustable rate that only goes for 5 or 7 years, and those rates are often a little bit lower than fixed, that might make sense. For a lot of people though, the risk of how much it could change gives them heart palpitations. It's not worth it. Also with rates being so incredibly record-breaking low, it's pretty hard not to want to just lock in on a fixed rate. But again, that's something you would want to talk to a lender about as far as different options. And as far as loan terms, typically I think most people hear about a 30-year or a 15-year, okay? But there are other loan terms available, 25-20, not as commonly talked about, but they're all options out there, so it's important to know. And I think the short story and all that would be the longer loan term of a 30-year means we're stretching out the repayment of that loan over a longer period of time, which keeps the monthly payment lower, which is why, although 15-year has a lower rate and seems like a really great idea, you might have a monthly payment that's $500, $600, $800 a month more than what you would do on a 30-year. So that might not make the most sense for you. And again, that would be something good to talk to a loan professional about to get a good idea of what option there would make the most sense.
All right. Let's talk about, I'm going to kick it right back to Aimee, but I'll be our MC here. How much money do you need? Yeah, for sure. We're a team. How much money do you need to get started? You have a few options for down payments, and they each mean different things for you. All right, back to you, Aimee.
Thank you. Yeah, so down payment is your investment in that property, and lenders want, the more money you put down percentage wise, the happier they feel that you're really vested in that home, and it makes it a little bit harder to be like, okay, I'm going to stop making payments and walk away, right? So 20% down was always the gold standard. That's what everyone strove to do. And also for many, many years in our parents, generations and grandparents, certainly, you really couldn't do less than 20% down. So that's kind of been the thing. But in, the past, I'd say 30 plus years at this point, there's what's called private mortgage insurance, or PMI. That mortgage insurance is bridging the gap. If you have less than 20% to put down, that will allow you to do a 5% or 10% or 3.5% or 3% down. And you're going to then also pay this PMI, or private mortgage insurance premium. And in that way, the lender is covered if you default or go into foreclosure. If you stop making your mortgage payments, there is some coverage there for the lender to recoup some of their losses from the loan. And in that way, then we are able to offer so many great financing options with less than 20% down. So PMI is not necessarily the evil thing that I don't want to pay PMI. I don't want to pay PMI. I get that all the time from people. I get it. Making an extra portion of your payment may not feel like the most affordable or smart thing to do. But we can also take a look at, okay, if you paid 20% down, or if you did 15% down, here's the difference in your payment relative to the PMI. Here's the difference in your cash to close. You might go, oh, okay, maybe I would rather have that extra $18,000 to update the kitchen or the bathroom, and that monthly payment difference isn't that big a deal. Okay, I'll do the PMI for a while and I'll deal with it.
Can I really quick on that, Aimee?
Yeah.
I can't tell you how many people have said, oh, I'm not ready to buy. We're not ready to buy yet. We're trying to save up. We don't want to pay PMI, so we got to save up for the next couple of years. So they spend 2 years saving up 20% down so they don't have to pay PMI. What do they pay in the meantime? Rent.
Right.
They successfully avoided depends, $100, $200 a month payment, which is, it sucks to add that on top of your mortgage. But in the meantime, you spent $30, $40, $50, $60,000 on rent over that period of time.
Easily spent that much in rent. Yeah.
That's the only reason. Please don't wait. If there's other reasons, then great. Hang
That's right.
tight, but
I appreciate you mentioning that, because that is, and I get it. Like it's not a bad thing to want to save and put more money down, but you have to look at the opportunity costs too. By paying rent for several more years while you're trying to save, what are you losing there? Our home value is going to continue to go up. Will interest rates be as low as they are right now? If rates are 1% higher, like your affordability as far as what you can qualify for is going to change dramatically. So there's a lot of lost opportunity there. And part of what I love to do is this cost analysis where I do compare some different down payment scenarios side by side so that you can see, okay, if I put 5% less down, maybe that's going to change my monthly payment $95 a month, but I'm keeping an extra 15,000 or whatever it might be in the bank. And if you're comfortable with that monthly payment and you're paying something similar in rent, oh, by all means, please put less down and let's get you into the home ownership, seat as opposed to the renter who's paying the landlord's mortgage. So
Aimee,
that's part of the consultation I love to do with people.
Is this a good place to talk about saving methods? Does it
Yeah,
matter?
I saw that question. Yeah, I think that's great. So one of the things that I do like to do, Caitlin brought up that question, so thank you. One of the things I like to talk about, especially if I get in front of you far enough in advance, that you're like, I know my lease is not up until May of 2021. Okay, great. Let's look at how much are you paying in rent right now? How much do you think you'd be comfortable paying in the future to own a home? What areas you're looking at? We can do all kinds of conversation on that. But then let's bridge the gap. So sometimes I'll tell people like, hey, maybe if you're paying $2,000 a month in rent right now, and we're thinking you might be paying about $2,500 a month to own a place, over the next 9 months, every time you make your rent payment, put an extra $500 into a savings account that you are using. And you obviously can put other money in there too, but it also helps you get comfortable with what that monthly payment could be. As far as actual savings methods, I think the challenge with the CD would mostly be how far out is the CD going to have your money locked in? Are there any penalties to close it out early? And what are you earning on it? Unfortunately, with rates being as low as they are, we're also not seeing a lot of return on investment for those shorter term savings vehicles. So I don't know if you have a trusted financial advisor or someone that you could talk to about that. But to me, that would come down to how much will I earn interest rate wise on what I'm saving, and what is my access to that money. So if my CD is locking my money up that I would use towards a down payment for 6 months or 12 months, I want to make sure I'm comfortable with that money not being accessible. If you had it in a savings account, you're probably not earning much at all, but at least you have access to that money. So I think that really depends on the individual as far as which route to go, but having an idea of how much you want to have saved to achieve the monthly payment you would be comfortable with when owning a home, that might also help you decide how much more you do need to save and which option makes the most sense.
What about retirement accounts?
What's that?
What about retirement accounts? I know that's a little advanced, but
yeah,
sometimes
that's
it's
okay.
like
I mean,
kind of a difference maker for
sometimes.
people. So yeah.
Yep. Typically, most retirement plans do allow for up to 50% of your vested balance that you can borrow against or take a loan against for the purchase of a home. So that's something that you'd want to look at. I do recommend looking at a loan as far as opposed to a withdrawal. The withdrawal, typically you're going to have some tax penalties for it, which you don't want.
Do that.
Yeah, you really don't. I mean, it would be a pretty extraordinary circumstance, in my opinion, that that's the route you would go. Yeah, it's your money, so you do typically have access to it. So the best thing would be to contact your plan administrator, contact your human resources person and say, how do I figure out how much I could possibly take out? Do I have to pay interest on that loan, or is it an interest-free loan? Different plans are set up with different options, but a 401k loan, it's not anything that a lender is going to look at as a negative. It's your money. You just have it in a different investment vehicle than a traditional savings account or mutual fund. So
yeah, don't go raid your retirement account to buy a home. But if you are trying to decide whether you can afford to do that, or whether you can put down 5% or 10%, sometimes talk to your, as Aimee said, talk to your plan administrator, but you can borrow a portion of that money, and that you still have to pay it back, right? So if you only have 5% down, you're still getting a loan for 90% of the purchase. It's just that on a portion of that 5% that you took from retirement, that interest typically gets paid to yourself. So you're not paying it to a bank. You're paying you have to pay it back, but you're also paying it back to yourself. You're not going to get the same loan term. It's a little advanced, but if you're
Yep.
kind of on that bubble, it's something to explore. Just throwing it out there for you.
Absolutely. I think the last part on this slide, which is a quick mention of down payment assistance. There are some programs out there that do offer down payment assistance. The challenge is they all come with strings attached, typically related to how much your income is annually. So because we live in a rather expensive real estate market, more often than not, what you're trying to qualify for means you're earning more money than those programs are going to support or allow. So it's something we could always talk about and look at, but it's not an option that we get to take advantage of all that often for a lot of buyers that we work with. All right, so I think, we talked about the different down payment options, but number one, it's important to you, like, what does that mean to what your monthly payment's going to be? But I think Mike's going to touch on, from a purchase and negotiation standpoint, why that's important as well.
Yeah, I just want to throw a couple of quick notes here in terms of how your down payment kind of affects the rest of the process. So as Aimee said, and as we said earlier, don't not buy a home for 3 years just so you can get to 20%. But if you do have 20%, do know that is sometimes looked on a little bit more favorably when you eventually find the place and you want to make an offer on your home. A big part of your realtor's job is to actually kind of sell that offer to the listing agent and the people who own that home right now, especially in a competitive market, which we're often in. They might have options. They might have other people who are interested in buying their home. And even if they don't, you want them to give you a discount on the price typically, or give you terms that are favorable to you. So as part of that, your agent is going to kind of say, hey, here's all the great stuff about this offer and why you should accept our price or our closing date or what have you. And so your down payment can affect that a little bit. I don't want to get into all the little details on this call because we'll be here all day, but it does help the higher your down payment is. Additionally, if you're putting down more than 10% and you're buying a condo, that's helpful too. That's something we can pitch and sell to the to the people we're trying to get to accept your offer. Because if you're putting down more than 10% on a condo, especially if it's a smaller building, that means you get to do something what's called a limited condo review. Anytime you're putting down less than 10%, it's a full condo review. Aimee's team loves doing those. It's
especially with self-managed.
Especially with a small self-managed building.
Yeah.
Basically what it means is just before they give you a loan, not only do they need to approve you, but they also need to take a look at this condo building and just make sure that they're cool with how it's being run. And if it's more than 10% down, they're going to be fine with. They're not going to be super sticklers about it. If it's less than 10% down, they're going to look at a lot more. They're going to want a lot more information. And usually it's fine. There's usually nothing wrong with the condo building. The problem is they're asking this poor person who volunteered to be president of their 3-unit homeowners association in their 3-unit building in Ukrainian Village. And this person has a job and a life and kids. And they have this, fortunately, if it's Aimee's team, they're going to have, a professional who knows how to work with them. But sometimes they just have this person in Arizona saying, need proof of turnover from builder to HOA or something like that. And they're like, what?
Right.
They just copy paste something from an underwriter and send it to this poor person who's volunteering to manage their HOA. It's a pain, and the listing agent and the sellers end up dealing with it. So if you're putting down 10% more, we can sell that. So that's good. I probably got a little too detailed on that. Last but not least, if you have a financial advisor, talk over your down payment options. Like I said before, just because you have 20%, honestly doesn't mean you should put all 20% down into an illiquid asset like a home. You might want to stay a little bit more liquid and put down 10%, pay the extra interest, pay a little bit of PMI, but then put that money in, I think Kate mentioned a couple of other savings vehicles. You put that in the market right now and it seems like it's doing pretty well. You might do better there than you do, the value of your home is going to appreciate or depreciate by the exact same amount, regardless of your down payment. It doesn't help you. So all it really is the savings on interest in PMI that you're looking at. And right now, that's 3 or 4% all in with the PMI and everything, and that's tax deductible sometimes. So really, if you can do better than 4% someplace else, you might want to think about it. That's all I've got on that. So I'm going to kick it back to Aimee, who's going to talk about your monthly payment. Right now, if you don't own a home, you're just paying rent. The amount is really simple. It's the number on the top of your lease. But when you're owning a home, there's a few more things involved. So Aimee's going to take this.
Yes. So payment, what comprises a mortgage payment? So you've got the loan, right? So you're paying some of the principal on that loan, but you're also paying a lot of interest on it. But that's the principal and interest part of the payment. Then of course there are property taxes when you own a home. On a condo, quite often, especially if you have parking, you're going to pay tax on the condo unit and on the parking spot. You want to have insurance on your property. But first of all, lenders are going to require it. Secondly, it's crazy not to. You need to have some coverage in case something does happen. And insurance, especially on condo units, is far less expensive than a single family. So it's not even that much more than renter's insurance. The other factors, of course, if you're looking at a condo or a townhome, you're typically going to be looking at homeowners assessments that are paid monthly. And then we also, as we've mentioned, if you're putting less than 20% down, you are going to be paying mortgage insurance. And something I did not touch on in the previous slide is mortgage insurance is not in place over the life of the loan. Once you pay down your loan balance a certain threshold, that mortgage insurance policy actually cancels and you no longer pay that premium. So that all depends on how much you put down. And if you make extra payments here and there, you can actually accelerate the point at which the PMI is no longer being charged to you as part of your monthly payment. So just know that too. PMI is not a forever thing unless you're doing FHA. That's another story. But yeah, your payment. So that's it. The terminology you might see sometimes is PITIA, which would be principal, interest, taxes, insurance, and assessments.
That will be on the test.
You're right. That's right. How do you calculate what your monthly payment is? There are definitely calculators out there all over the web that you can try and estimate what your mortgage payment is going to be. I have a mortgage calculator on my website. You're welcome to use any of those tools. It's a great little starting point, but I would definitely recommend this is where talking to a professional makes a lot of sense too, because what exactly are you qualifying for on the PMI and what rate are you qualifying for? That can change pretty dramatically what monthly payment you're looking at. So getting a sense of that by actually talking to someone sooner than later is a really good idea.
Thanks, Aimee.
Yeah.
And yeah, I just working with a lot of people who are early in the process, I've noted that's kind of the gap that's missing. You see all these homes for sale online and say 2-bed, 2-bath, condo, $400,000. Well, cool. As stated, I don't have $400,000. So what does this actually mean to me? And when you plug some of those figures in that Aimee just mentioned, the price, the property tax amount, and the assessments, it'll estimate most other things for you. It'll give you a rough idea of what the monthly payment would be, down payment. So the price, down payment, property tax, and the homeowners association dues. In Chicago, keep an eye out for that. You're not buying a single family home in a gated subdivision in Naperville where you pay $400 a year. You might be paying $400 a month or more on some properties.
Yeah.
Yeah. So that's but that kind of helps fill that gap.
It does. I'm going to chime in one last thing on that. Sure. I think you're right, especially depending on the type of condo project, a high rise with all kinds of amenities, you will see the assessment could be, kind of literally through the roof, figuratively through the roof. 3-story walk up,
literally like it just
a lot cheaper, right? But also property taxes are important to look at. So when I'm trying to help people determine what they qualify for, what's most important to me is meeting kind of a monthly payment budget that they're comfortable with. The tax is a big part of it because depending on the area or the property, the taxes can vary pretty significantly. So that's something you want to pay attention to as well, especially if you're looking at all in the suburbs. Like different suburbs definitely have very different tax rates. So it's not just about the sales price. You know, I think ultimately I hear a lot from people like, well, I'll say, well, how much are you comfortable spending on a monthly basis? And then they tell me, well, I don't want to spend more than 400,000. I'm like, no, I'm not asking you about the sales price you think you should do. I'm asking you, like, what's your budget for your monthly payment? How much are you paying currently in rent or on your mortgage? How comfortable are you going up to? And then I tend to work backwards and say, okay, factoring in where you want to buy, making some knowledgeable estimates on taxes and assessments, let's back into what that actual sales price range would be so that your monthly payment matches the sales price that you're actually out there searching for. And that's why Mike likes working with me, because we make sure that people do that, because it could be very easy to get stuck thinking you can't go up a little bit in sales price when you might be able to, just because you have this preconceived notion of what a price would be relative to the payment.
Yeah. Or you think that you can afford a certain place and then you realize the HOAs are $1,200 a month.
Oh, that's the other one.
So all that stuff is on the listings. When you're looking at homes online, look for those things: homeowners association dues, property taxes. All that will be on there, typically somewhere near the purchase price. So that's where you get that information.
Okay.
Cool. All right, let's get you guys moving a little bit. Aimee and I have been doing all the work here. We're gonna do a little activity. So we just talked about kind of what goes into a monthly payment and gave you a couple of tools for how to convert a property you see online into a monthly payment. And Aimee's gonna talk to you about, what do you want to spend on a monthly basis? But there's one other thing, which is, what is the bank willing to loan you? And mostly that is determined, once you've got the down payment, that's determined based on based on how much you are able to spend on a monthly basis. So we're going to do a little exercise right now. Grab a pen, grab a piece of paper or anything that you can write on. Don't type this into the chat box. Do this privately. We're going to do a little exercise here. So what you're going to do is you're going to take how much you make per year and divide by 12 to get your monthly gross income, okay? And this is before any taxes or retirement savings or anything like that, before any of that's taken out. So if you make $120,000 a year, it's $10,000 a month. If you make $60,000 a year, the number you're gonna put here is $5,000. Once you have that number, you're gonna multiply it by 0.45 on the calculator on your phone, or if you're really just kind of eyeballing this, just divide it by 2 and a little less than that. But on the calculator on your phone, take that 5,000 number, multiply by 0.45. And then the last thing you're gonna do is subtract any other monthly payments you make to debt, right? So it could be a car payment, it could be student loan payment, credit cards, all kinds of different things. Take the monthly payment. If it's a credit card, Aimee, you use the minimum monthly payment, right?
What's that? Sorry, the minimum monthly payment for credit cards, yes.
Yes, exactly. But consider paying off your credit cards before you take on a whole lot more debt. So you're gonna, just to recap, take your monthly gross income, multiply by 0.45, that's 45%, and then subtract all of your other monthly payments. And that's gonna give you the maximum number that a bank would be willing to let you spend on a monthly basis. So some people are like, okay, got it, looks good. Other people look at that number and they say, I'm not gonna spend that much money on a home. That's crazy town. Good, don't. Just know that a bank will probably pre-approve you for significantly more than you wanna spend on a home. And that happens sometimes, but that doesn't mean you need to spend that much money. And a good lender like Aimee is going to say, actually don't. That's why she asks first how much you want to spend. I think that's kind of how you run things. Like you're not
100%.
necessarily, yeah. Okay. So this is sort of black magic here, but I wanted to give you guys a little bit of a peek under the hood of how things work.
Well, and this is basically like pre-qualifying yourself for a loan,
Right.
other than, that tells you how much payment wise you could get. What that means as far as sales price and whatnot is more what I would do, but it would give you an idea of, okay, maybe I shouldn't look for a place that would make my payment higher than this amount.
Right. Cool. All right, I'm going to kind of keep it moving here because I realize we're coming up on time.
Yeah.
But if that was looking like a lot of math, keep an eye out in your inbox after this. We're going to send you a calculator that'll just kind of do everything that we showed you there for you and in a little bit more detail. But if you really want to know, have a conversation. There's that. If you really want to know, have a conversation with Aimee and she'll give you a much better idea. All right. We're still in the how much money do I have section.
Right.
We're not going to break down all of these, but it is important to know that in addition to your down payment, there are some costs associated with buying a home that you're going to need to be aware of.
That's
Go ahead,
right.
Aimee.
So, and really there's really kind of two categories. There are the mortgage closing costs, or those that are essentially lender specific. And then the other side is, okay, what are the other costs that aren't lender specific? So yes, lenders all charge some kind of fee to do your loan. Honestly, we are all typically within a couple $100s of each other as far as our lender fees. So if you're trying to shop and compare, you're probably not going to get super excited that one lender would save you $219. But maybe you would be. Appraisals, same, pretty standard. The condo questionnaire is one fee. Mike had mentioned, we are always going to be looking at approving the condo project as well as you as the buyer. And so that questionnaire is something that gets sent to the association. So whatever the association is going to charge is what you're going to have to pay. And then we, of course, are going to have fees for running your credit report. Some lenders also charge an application fee. Really, I think the main thing to know is all of these costs, for the most part, are paid at closing. The only thing you may be asked to pay up front would be some kind of application fee that would go towards the appraisal cost or to submit the loan to underwriting. But it is a closing cost, so it would be credited to you at closing. It's not lost money. But you should never have to pay all the closing costs up front. It would be at closing. Other lovely fun ones, the outside of mortgages. So the most expensive one, especially buying in the city of Chicago, is the transfer stamps. That's calculated as $7.50 for every $1,000 of the sales price in the city of Chicago. Other towns in the greater Chicago area, some do have buyer transfer stamps as well. None that I've encountered as expensive as Chicago, but some do, many don't. So that's just something to be aware of depending on where you're buying. That could add a couple $1,000s in closing costs. You get a homeowner's inspection. That you're going to be paying up front. You'll have a real estate attorney represent you. And Mike and the Center Coast team have some great attorneys that they work with, so you wouldn't have to necessarily go find your own attorney. Title fees would be another more expensive section as far as closing costs. I would say in Chicago, we're typically seeing about $3,000 to $3,500 being charged for title fees. And then the homeowner's insurance. Again, want to make sure that you've got insurance on your property. So the day of closing, if something happens right away, you're covered. You do have to pay for that first year of the policy up front. And then seller credits. It's always an option to ask the seller as part of your initial offer to pay for some closing costs. It's usually as a dollar amount or percentage that you're requesting that. Sometimes, quite often, those credits come up after the inspection that maybe there's a few items that you want to negotiate that they either take care of or give you a credit for. And so that can help offset these closing costs. But I would say, honestly, not to scare people, but typically closing costs, we're looking at $6 to $9 grand in Chicago. And again, it depends on the price of the property you're buying because of those transfer stamps, but it's a good chunk of change. So when you're saving up so much for down payment, there's a portion that's going to go to closing costs. And when I do my cost analysis with my buyer clients that I'm talking with, I always get into detail on all these costs, so you're not at all surprised at what you're going to encounter.
Cool. Yeah, and just the seller credit, sometimes that kind of comes into our arena as the agents responsible for negotiating that. What that really is basically, think of it as like kind of an instant rebate. So you tell a home seller, hey, we'll pay you $400,000 for your home, but we actually want a $5,000 credit. So every seller is going to immediately do the math and say, I get $395,000 for my home. And it's all the same to them. So why wouldn't you just offer them $395,000? Well, remember, you're only putting down, we'll say 10% of the purchase price. So even though, so they would have just sold you the home for $395, but you're only going to end up paying an extra $500 because you're paying an extra $5,000 for the home than you could have got it for. So you pay $500 more out of pocket, but they instant rebate you back $5,000. So actually, you end up bringing $4,500 less to closing. If that was some math for you, don't worry. That probably wasn't my best explanation. Maybe I'll take a mulligan on that one of these days. But basically, you can get sellers to pay for some of your closing costs. It's effectively like rolling them into the purchase price. Just think about it that way.
Yep.
Cool. All right. So you got a good primer, a good base. How do you go out there and get pre-approved? In fact, what even is a pre-approval? Let Aimee take you through that.
I mean, we've touched on it in various ways on these slides, but I think that's perfectly said. Meet with the lender and get aligned, right? Like what do I want to do? When do I want to do it? How much do I want to spend? What program is going to make the most sense for my situation? These are all the questions that we're asking and discussing together. I use a 3-step buyer process to get you through that. And all my consultations are typically by phone. So we can knock some of these out in as little as 10 minutes. And sometimes that's at 8 o'clock at night because you can't talk about personal stuff like this during the day. So a pre-approval consultation can look different depending on who you're talking with. Some people will just go online right away and apply and then have the conversation later. It's really up to you. I think I like to get to know a little bit what you want to do. That monthly payment goal is a really big one for me, and to get a sense of what's important so that I can put together the right strategy of what loan would make the most sense for you. So that's the gist of the consultation. Once you're feeling better about that, then you're going to do the pre-approval application, which will also enable us to do a credit check. And that's hugely important. We've talked about that already. But then you know where you stand with the lender. If there are any things in your credit report that might be an error or things that you could address to maybe improve your credit and get an even better interest rate, you have time and you can work on that with the creditors, or I often give some advice and there are things we can do to help improve things quickly. Having that credit check also lets us see what are your monthly payments that the credit report is showing. And that helps us make sure your qualifying ratios as far as all of your expenses and how much you'd be spending on the condo or house you want to buy, what that is in relation to your income. Do you meet the standard qualifying ratios there? And yes, credit scores definitely impact rates and closing costs. Ideally, if you're over 740, like you're golden, you're going to get the best of everything. 720 to 740, still pretty darn good. You start getting under 720, it's not going to be the end of the world, but you're not going to get the absolute best rate that you're seeing out there. And then once we're under 700, then we might even start looking at are there things we can do to improve your credit, or perhaps a different financing alternative. And again, showing those options side by side to give you a sense of what would work for you is what we would do. Yes. So once we've got that data, then it's okay. You think you want your payment to be no more than $3,000 a month in the areas you're looking at. Okay, with this amount down, this percentage amount down, this is what your monthly payment would be. This is what your cash to close would be. That includes the closing costs. We're going to review all of that. What rates make the most sense? Do you have PMI or not? Getting into all that so that you feel really confident when you're going out there to start searching or making an offer on a home is really important to me. Been doing this for 15 years, and I think that's really the key of the relationships I have is really digging in and giving. I mean, I had like a 40-minute call with somebody earlier today from Center Coast Realty that, you know, she's not going to be buying until next year, but we're still talking about these options so she can feel confident and prepared when it is time to go. She also realizes, I'm starting to look online a little bit and I might end up wanting to make an offer on a place sooner than I was intending, which happens a lot. So the more of this busy work you can get done up front, the more confident you will feel moving forward. And the last fun part, the document chasing, for sure. I mean, we need to verify the information you're telling us that we're using for your pre-approval. So we're going to approve some income. I'm going to need some W-2s, some recent pay stubs. What assets will you be using? Is some of that going to be a gift from a family member? Have you been divorced? Do you have child support? There are different things that we would need to document. So being prepared that you will need to provide that information is important. If you are self-employed, it's hugely important that we're looking at tax returns and doing a proper analysis up front to make sure that we're going to qualify you for what we're trying to propose to you. That's definitely a whole other webinar we could do about self-employed buyers, but just do know that that's a really important thing that we'd want to look at if you're self-employed.
All right, folks. You know a lot more about mortgages than you did a little while ago. Probably still have a lot of questions, but that's okay. We're going to talk about how to go ahead and get started with this process, especially if you're at that kind of 6 to 12 month mark and you want to start educating yourself a little bit more, figure out what all this really means for you in particular. I want to touch on something here quickly when it comes to the first thing you should do, which is choosing a lender. There's a reason we had Aimee on this call and not, a lender from another organization, we'll say. When it comes to choosing a lender, bigger isn't necessarily better. And this happens a lot. A lot of people are looking at their checking account one day online and they see a little notification. It says, you can have a mortgage. And they say, okay. And they click it and it says, voila, you're pre-approved after a few quick inputs. And they end up talking to kind of the 800 number at their national retail bank. And then they think they're pre-approved. Sometimes they are, but I wouldn't necessarily rely on that pre-approval. And when it comes to the underwriting process, when it comes to actually making an offer on a home, getting it accepted, there's a little bit of a process to get fully approved for the mortgage after you're pre-approved. And this is getting like way ahead of ourselves. But I need to put out this PSA now. Please work with a local lender who understands mortgages in Chicago. Mortgages should be the only thing they do. If they also run your checking account and a whole bunch of other things, and they're all over the United States, it's just, it's a cluster. And it may not mean much to you right now, but when your lease is ending and your movers are calling you and saying, hey, where should we take your stuff next week? And you don't know because someone in Tucson is out sick and they've been having this whole back and forth with, we talked earlier about the poor person who's in charge of running the HOA for your new condo building, and that person hasn't been able to understand their instructions. And then there's a processing team in Raleigh, and what else? The underwriting in Denver, and no one knows what the other one is doing. It can be a bit of a mess with these national chain banks. So that's like a big retail bank. If that's where your checking is, unless you're with like a local credit union or a local bank, wherever you're banking is probably one of those banks that I was telling you about. That's a retail bank. You want to work with a mortgage bank. That's a bank that specializes almost completely in mortgages. They're still funding your loan with their own money. They have underwriting in-house. That means the person who officially decides whether you get this loan works at the same place as Aimee. So does the person who makes sure all the paperwork is in the right place on closing day. And so does the person who makes sure that your condo is going to work for your bank. They all work at the same place, which means Aimee knows them. And if someone's being a little slow, she could roll over there with a cup of coffee and say, hey there, we got a closing in 2 days. We really need this. We need to get this pushed through, as opposed to trying to call. And literally, we've had people, the actual lender who works for the giant national bank, they have to call an 800 number at their own company and try to get through to the person. So I got a little bit of a soapbox on this one, folks, but man, do yourself a favor, do your realtors a favor, and just do the right thing when it comes to picking a lender. Another option is a mortgage broker. This is someone who actually, they basically work with, basically the main difference you need to know here is they aren't gonna have the underwriting and processing in-house. They may have a lot of options, unlike a retail bank, but a mortgage bank has a lot of options too. So that's typically the way to go. I've said my piece on that. This pre-approval that we've been talking about this whole time, This is your ticket to ride. Okay, so like we've been talking about, it's a competitive market. Sometimes if you want to purchase a home, more than one person does. But the real truth of it is no seller is going to accept your offer until you have this pre-approval. So it's super crucial to get that homework done early in case something pops up. We've had people procrastinate. It's this big paper chase trying to get pre-approved. And the next thing they know, someone else has scooped up that dream home that they were interested in. So we don't want that to happen. Get a jump on things. I did want to touch on briefly, just because this comes up sometimes. Getting pre-approved doesn't mean you're fully approved. We kind of talked about once you're under contract, you're going to have to, once you've made an offer to a seller, they've accepted it. That means you're under contract. And now it's time to go get officially approved for your loan. If you've been working with a good lender who knows what they're doing, your pre-approval should be pretty solid. But people are still sometimes worried. They're like, oh, what if I don't get approved? Am I going to lose all my money on this home? And the answer is no. There are terms built into the contract that make sure that if anything goes wrong with your mortgage, you're protected. You're not going to lose your life savings. You're not going to get sued by a home seller because something went wrong with the underwriting process. But it doesn't happen very often. I mean, that's pretty rare. If anything, it's the appraisal that'll pop up from time to time. But you are protected in scenarios like that. Oh, here's a couple of good ones. I'm gonna kick this over to Aimee, but Aimee, a couple don'ts for the group today, right?
And I won't belabor the point. Just essentially try not to make any big changes while you're trying to get approved for financing. I mean, that's really it. Like applying for new credit or not making a payment or making large purchases, buying a car, switching jobs, moving lots of big chunks of money around without being able to explain where it came from. These are all going to be red flags and problems and things that we're going to have to document. It doesn't necessarily mean it's a deal breaker, but it could be. I think on the switch jobs thing, that does come up from time to time, certainly. And if you're a standard salary W-2 type of employee, then it really shouldn't be a problem at all. When you're 100% commission and you're changing industries, that's a big challenge. So it's, I think, just important to be communicating with and partnering with your loan officer to make sure that he or she knows what you're doing and asking maybe before you make the change. Like I just got a text from a client who said, my car just died. I think I have to buy a new one. Is that going to ruin my financing? Because we had this conversation, so she knew to check with me. Luckily for her, I looked at the numbers. It's not going to be a problem to qualify her with a new car payment because it had been paid off. But these are important things. So the main thing is try not to make big changes. If you think you might need to, just communicate, because really the loan officer is there to help you get to the finish line and buy a home. So you want to be communicating with them and letting them know those things. If you try and hide it, guess what? We're going to find out, or I should say better yet, the underwriter will find out, because that's their job, is to tear things up and figure out and make sure everything meets the guidelines we need. So if you need to do a change, let us know.
I had a buyer who was buying a investment property, and you'll love this one, so already a little bit more challenging. Call me 4 days before closing. How are you doing? He said, I'm great. I just bought a new Mercedes. I'm psyched about it. And I was like, oh no. And then I was like, have you talked to your lender? And he said, no, why? And I said, because we told you to. Yeah. And it turned out he was just so rich it didn't matter, but that must be nice for him.
Yeah, well, some car payment can be—
he was self-employed.
Like a mortgage for some people. So yeah, it's important to communicate it.
Anyway, communicate, that's the takeaway there. All right, what do we do now? So if you're super far out and you're just like, ooh, talking to people, I don't know about that. Keep an eye out for the email that's going to be in your inbox after this. It's going to have a link to our buying power calculator. Give you kind of a rough idea of how much of a home you can afford in terms of a monthly payment. And it'll also tell you what that looks like in terms of a purchase price. So it'll help you do those first couple of searches that you're going to do at centercoastrealty.com. But if you want a little bit more information, if you want to start, if you're serious about buying a home eventually, it doesn't have to be serious about buying a home now, but if you're thinking, you know what, this is something I want for myself in the next year or even 2 years, have a quick phone call with Aimee and just get an idea of where you stand. She can let you know if it makes sense to what it makes sense to do now, and what you can kind of work on slowly as you go through here. So I think, yes, I think that's it. Do you guys have any other questions? All right, if you do, you can reply to that email. We get those. Reply to that email and we can answer them there. As always, we're here to be a resource. Education is a big part about what we do. So all this is just about getting you prepared so you're ready to make those moves.
One thing I wanted to mention on that last slide, Mike, there's no cost to you to have a consultation with someone at Center Coast or someone with me, like that we're essentially compensated when your purchase closes. So everything until that point is, it's time. It's your time. It's my time. I'm happy to do it. That's my job. And that's what I love to do. It always makes me sad if someone's like, oh, I went and I was like looking for that answer online. Just come to me and ask, but just be aware, we're not going to charge you for these phone consultations. They truly are free. We wouldn't charge you if we were meeting in person. So doesn't have to be scary. Hopefully you realize we're, pretty relaxed and normal people, and we'd love to hear from you.
Awesome. All right, folks. Thanks for stopping by. You know where to find us. See you next time.
Thanks, guys.